stop scrolling. If you are over age 65, the IRS just gave you a massive gift for the 2026 tax season, and almost nobody is talking about it. Everyone knows about the standard deduction, but did you know there is a new enhanced deduction that could let you write off an extra $6,000 of income this year? This means a single senior could potentially earn over $24,000 absolutely tax-free. In this video, I'm going to walk you through the new 2026 tax math, explain who qualifies for this $6,000 boost, and show you exactly how to claim it. First, let's look at the numbers. For 2026, the regular standard deduction for a single person is $16,100. If you are 65 or older, you get an age bonus of $2,050. So, normally, you can earn $18,150 before you pay a penny of federal tax. But here is the change. Under the new 2026 rules, eligible seniors can claim an additional $6,000 enhanced deduction. Let's add that up. $16,100 plus $2,050 plus $6,000 equals $24,150. That is $24,150 of income that the IRS cannot touch. To make this crystal clear, let's look at a real-world example. Meet Mary. She is 68 years old and single. In 2026, she receives $22,000 a year from Social Security and withdraws $5,000 from her IRA to pay bills. Her total income is $27,000. Under the old rules years ago, she might have worried about paying taxes on that IRA money. But look at the 2026 math. Her standard deduction is $16,100. Her age bonus is $2,050. And she qualifies for the new enhanced deduction of $6,000. That creates a tax-free shield of $24,150. Since her taxable income, the IRA money, is way below that shield, Mary pays $0 in federal tax. She doesn't even need to file a complex return. This deduction wiped out her liability completely. Now, who gets this money? There are two main rules. Rule number 1. You must be 65 or older by the end of the tax year. Rule number 2. There is an income limit. This deduction is designed for middle-class seniors. If your modified adjusted gross income is over $75,000 for singles or $150,000 for couples, this extra $6,000 starts to phase out. But for most of you watching this channel, if your main income is Social Security and a small pension, you likely qualify for the full amount. I need to slow down here because this next part is where people get into trouble. I mentioned the tax torpedo earlier. Let me explain exactly how to calculate it, because the $6,000 deduction does not fix this specific problem. The IRS uses a separate formula to decide if they can tax your Social Security benefits before you even get to use your deductions. It is called Provisional Income. Grab a pen. Here is the math. Take your annual salary or pension. Add any tax-free interest. Then, and this is the kicker, add 50% of your annual Social Security benefits. If that total number is over $25,000 for singles or $32,000 for couples, the IRS can tax up to 50% of your benefits. If it goes over $34,000 single or $44,000 couples, they can tax up to 85%. The new $6,000 deduction helps you after this calculation, but it does not stop the IRS from counting your benefits as income in the first place. You need to manage your IRA withdrawals carefully to stay under these limits. If you are married filing jointly, it gets even better. Each spouse gets the $6,000 bonus. That is a total of $12,000 in extra deductions. When you combine the standard deduction, $32,200, the age bonuses, $1,650 times 2, and this new $12,000, a married couple over 65 could potentially earn nearly $48,000 tax-free. A quick warning. This deduction helps with income tax, but it does not change the provisional income formula that makes your Social Security taxable in the first place. You still need to watch out for that $25,000 threshold. However, this new deduction acts like a shield. It helps wipe out any tax bill after your benefits are calculated. So, when you file your taxes in early 2027 for the 2026 year, make sure your accountant knows about the enhanced senior deduction. Do not leave $6,000 on the table. One last question we get all the time. Should I still save my medical receipts? With this new $6,000 boost, for 95% of seniors, the answer is no. Unless you had massive medical bills, usually over 7.5% of your income, or huge charitable donations, you will almost never beat the standard deduction. Think about it. A married couple gets nearly $36,000 in standard deductions, plus this bonus. You would need a shoebox full of receipts to beat that number. So, for 2026, you can likely skip the headache of itemizing and just take the standard deduction. It saves you time and accounting fees. I want to know, does this new deduction help you stay tax-free? Let me know in the comments. Subscribe for more tax updates. Let me know in the comments. Subscribe for more tax updates.